Hello everyone. When people start learning about investing, they often hear the term mutual fund, but many aren't entirely sure what it means or how it works. Some investors assume mutual funds are only for retirement accounts. Others believe they're complicated or outdated. In reality, mutual funds are one of the most widely used investment tools in the world. In this video, we're going to explain what a mutual fund is, how it works, why investors use it, and what role it can play in building long-term wealth. By the end of this video, you'll have a clear and confident understanding of mutual funds and how they fit into investing. So what is a mutual fund? A mutual fund is an investment that gathers money from many investors to buy a collection of assets such as stocks, bonds, or other securities. Instead of buying individual investments one by one, investors buy shares of the mutual fund. Each investor owns a portion of everything inside the fund, proportional to how much money they invest. So why were mutual funds created? Mutual funds were created to make investing more accessible and diversified. By putting money together, investors could gain access to professional management and a wide range of investments. This structure allowed individuals to invest in markets that would otherwise be difficult or expensive to access alone. So how does a mutual fund work? A mutual fund collects money from investors and uses that money to purchase investments based on a specific strategy. The fund is managed by professionals who decide what to buy, sell, or hold their shares in a company. The value of the mutual fund changes based on the performance of the investments inside it. Investors earn returns based on their share of the fund. So who manages a mutual fund? Most mutual funds are managed by professional fund managers. These managers study markets, analyze investments, and make decisions on behalf of investors. Their goal is to follow the fund's stated objective, whether that is growth, income, or stability. So how do mutual funds make money for investors? Mutual funds can generate returns in several ways. Investments inside the fund may increase in value. Some investments produce income through dividends or interest. These earnings are passed along to investors, increasing the value of their shares or through distributions. So how is a mutual fund priced? Mutual funds are priced using something called net asset value, or NAV. The NAV represents the total value of the fund's assets minus its liabilities, divided by the number of shares. Unlike some investments, mutual funds are typically priced once per day after markets close. So how is a mutual fund different than buying individual stocks? When buying individual stocks, investors must choose specific companies. With a mutual fund, investors gain exposure to many investments at once. This diversification reduces reliance on the performance of any single investment. Mutual funds also provide professional management, which individual stocks do not. So what types of mutual funds exist? There are many types of mutual funds. The main types of mutual funds include stock mutual funds, bond mutual funds, balanced or blended funds, target date funds, and money market funds. Each type of fund is designed to meet different investment goals and risk levels. So how do mutual funds manage risk? Mutual funds manage risk through diversification. By spreading investments across many assets, losses in one area may be offset by gains in another. Professional oversight also helps monitor risk exposure and adjust strategies when needed. So, can mutual funds lose value? Yes, mutual funds can lose value. Because they invest in markets, their performance depends on economic conditions and market movements. Diversification reduces risk, but it does not eliminate it. So how does someone invest in a mutual fund? Let's look at a simple example of investing in a mutual fund. Imagine someone named Taylor wants to invest for long-term growth. Taylor opens an investment account through a brokerage or retirement plan. Next, Taylor reviews different mutual funds and selects one that matches long-term goals. Taylor invests $2,000 into the mutual fund. That money is combined with funds from other investors and invested according to the fund's strategy. As the investments grow, the value of Taylor's shares increases. Taylor can continue adding money over time to grow the investment steadily. So how do mutual fund fees work? Mutual funds charge fees to cover management and operating costs. These fees are often expressed as an expense ratio. Higher fees reduce overall returns, especially over long periods. Understanding fees is an important part of choosing a mutual fund. So, are mutual funds actively or passively managed? Some mutual funds are actively managed, meaning managers try to outperform the market. Others are passively managed and aim to track a specific index. The management style affects costs, strategy, and potential outcomes. So how do mutual funds fit into long-term investing? Mutual funds are commonly used for long-term investing. They allow investors to stay diversified and invested without constant decision-making. Many retirement strategies rely heavily on mutual funds. So, are mutual funds good for beginner investors? Mutual funds are often suitable for beginners because they offer diversification and professional management. They reduce the need to research individual investments. Many investors start building wealth using mutual funds. So how do investors choose a mutual fund? When choosing a mutual fund, investors often evaluate the fund's objective, past performance over long periods, fees and expenses, and risk level. Choosing a fund that aligns with personal goals is more important than short-term results. So how often can mutual funds be bought or sold? Mutual funds are typically bought or sold once per day at the fund's NAV. This structure differs from investments that trade throughout the day. It encourages long-term investing rather than frequent trading. So how do mutual funds compare to other investment options? Mutual funds offer diversification and professional management. They may have higher fees than some alternatives but offer convenience and structure. Each investment type has strengths depending on an investor's goals. So how should beginner investors think about mutual funds? Beginner investors should view mutual funds as tools for long-term growth and stability. They provide an easy way to invest broadly without needing deep market knowledge. Understanding mutual funds helps investors make informed and confident decisions. A mutual fund is an investment that pools money from many investors to buy a diversified collection of assets. It offers professional management, diversification, and accessibility for investors of all experience levels. While mutual funds carry risk, they play an important role in long-term investing and wealth building. By understanding how mutual funds work, investors gain another powerful option for building a balanced and thoughtful investment strategy. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.